There are many reasons why you wish to judge financial performance. It could be your own business. You need to know what's going on, how well you're doing, how well you're performing, and where the challenges are. You may wish to analyse the performance of a competitor, a business you're about to invest in. One of the most common techniques used to make these financial judgments is using a technique called financial ratios. In this video, I'm going to go through the 4 key quadrants of financial analysis using ratios. I'm going to go through what those quadrants are. I'm going to use a worked example here and add commentary on what those numbers are revealing. Hi folks, welcome to another weekly episode on I Hate Numbers. My name is Mahmood. I'm an accountant, I'm an educator, and also I'm the proud author of the book I Hate Numbers. Remember folks, I'd love it if you could subscribe to the channel, keep in touch, and I can share those videos and content with you that's going to increase your financial awareness, help you and your business make more money and save time and get to your end Northern Star. What's not to love about that? Let's crack on with the video. Now the 4 key financial ratio quadrants are laid out below, and we are looking at 4 key areas. Liquidity, which refers to the availability of cash in order to operate your business, and if you don't have that, then you will find business very difficult to maintain. Profitability, a very key number that we keep an eye on, and those are 3 metrics or measures or ratios. Take your pick of to which term you prefer. And again, in the example that I'm going to go through in a few moments, I'll explain not only what those numbers represent, what they mean, but how we perform the calculation and some possible interpretation. Efficiency refers to in a business, how well those assets that we have, those items of value within our business are being deployed to generate value and lastly, we look at investment ratios. So if you are an investor in another business, you're looking to invest in a potential business, or you're judging your own performance in your business here, we're going to look at some of those key ratios. Remember folks, this is a framework, a general framework of the 4 key areas, and within ratio analysis here, there are a whole bunch of other numbers that we can adopt and deploy to actually analyze either our own specific business performance or the performance of others. What's best folks is, let's crack on now with an example of those 4 quadrants, and what I'm going to share with you is this here. In front of us I've got 2 financial statements, and I've got a grid in the bottom left of the screen of the ratios that we are going to calculate. So here we have, on the top left hand side, we have an abridged summary profit and loss statement, which I've called P&L. You may come across that and call it an income statement. You may hear it called an income and expenditure statement. Now typically in this statement I've outlined what the turnover of the business is, and I've managed to differentiate between that activity which is cash and that activity which is on credit. Many businesses will provide services, sell goods and get cash immediately. Some will provide those goods and services on credit terms. We've then got something referred to as cost of sales, which is effectively the value of any inventory that we've acquired and we've manufactured or bought in, and we work out the cost of sales accordingly. And that gives us, first of all, the gross profit from that enterprise. This enterprise, I Hate Numbers, also has borrowed money, it has loan interest, it then has tax. Now I refer to it as income tax. Internationally, it's called income tax. Depending where you are in the world, you may refer it to as corporation tax or corporate tax. And lastly, we have the profit after tax. To the right hand side, we can see the company's balance sheet. And this balance sheet is a mere snapshot in time, summarising the assets that the organisation, the business has on that point in time. Typically at the bottom we can see also I've listed the market value of the ordinary shares, and some of these ratios are more relevant if you're a public quoted company. Then a market value will be achieved pool for your business. If you are a private company, perhaps those statistics may not be as relevant. Now at the bottom I've itemised and listed the 4 key quadrants that we have. So we've got profitability, we've got liquidity, we've got efficiency, and we've got the risk and return ratios as well. Let me go through and actually work out with these accounts what those numbers are going to look like. So our first calculation is called return on capital employed, and what this represents is the level of assets that we can quantify and measure in our business, predominantly made up of the issued share capital, reserves, and any long-term debt that we have, or what we call the net assets, the fixed assets in our business, plus any working capital, net current assets. And we want to look at how much profit we're generating before we consider interest and tax charges. Now, what we have there is in the first year, we generated 11.1%, and in the second year, 23.1%. What I'm going to do is to calculate the first quadrant, and then we can make some interpretations as to what those numbers are actually meaning. Now, the gross profit ratio is giving us an insight on the turnover that we generate. Of that, how much is our gross profit? And that gross profit is an important metric because that goes to cover our expenses, our operating costs, and that is more controllable by a business owner. And what we can see that in year one it was 26.3%, and it's gone up to 32.2%. Lastly, we're looking at the net profit ratio, which you may also come across as the operating profit ratio, and that looks at the profit that we generate before we consider financing charges and taxation. And what we've got there is gone from 9.9 and it's pretty much nearly doubled to 18.5%. Now, what does this actually mean? Now, first of all, as we can see by the actual numbers employed that the business has gone through a period of growth from $700,000 worth of sales to 930. We would expect to see some degrees of what's called economies of scale. So some of those expenses will be spread over a larger base, so we get those efficiencies coming in. We might have better purchasing power. If we're manufacturing, the more upscale the manufacturing is, then we're going to get those economies and efficiencies coming in. So a number of reasons have contributed to that, and there could also be a function of price changes as well. Now, if we come to look at liquidity, if we are a manufacturer, if we're a retailer, we invest in inventory, items to resell to our end customer. If we are offering credit facilities, we generate receivables. And also to finance the inventory acquisition, we will be buying items on credit, which we refer to as payables, or you might come across that as creditors. So let's have a look at that. Now, every time we buy stock in, raw materials, finished product, that's money tied up, and that's dead cash for us until it leaves the door and the customer eventually pays us. Every time we offer credit facilities, likewise, the same thing will happen. So let's have a look at the next two ratios. Now, the current ratio looks at the relationship between all the current assets, those are short term, which will eventually convert back into cash. So it's inventory, receivables, and the bank balance, and looks at it in relation to all the short term debt we have, which is the current liabilities. Now, if we look at it, relatively speaking, the current ratio is saying, okay, it's dropped slightly. So there's more money tied up in those assets. So, however, though, if we look at it as a trend, the liquidity for those two items is not that significantly different. Now, whether that's good or bad really depends on a trend comparing to the previous year. If we can get access to industry statistics, we can compare that, we can benchmark it as well. Now, the acid test, or the quick ratio as it's sometimes called, eliminates inventory out of that equation. What it's saying is inventory typically represents the least liquid asset that we know. If we needed to raise cash pretty quickly, inventory typically is the more difficult item to convert into cash at short notice. So if we didn't rely on that inventory, we can see it drops below 1 to 1. Some analysts will say anything below 1 to 1 is dangerous. That's probably a very blasé view to adopt. You need to really consider in terms of what the trend has been, but we've got some stability there, and it's showing us that the liquidity position on those two items is relatively okay. Now let's have a look at the efficiency ratios. Now, traditionally, these are how they're classified. I would certainly say when we look at some of these metrics here, they also give us an insight into the cash position, the liquidity of the company as well. So let's go through. Now, we've got 5 metrics there: fixed asset turnover. So that's looking at the fixed asset base and what that generates by way of turnover, because that's part of the infrastructure. We look at the expenses ratio. The expenses ratio typically found in the profit and loss account in relation to the level of turnover. Inventory days, again, it's tying up the level of inventory that we hold in relation to what's called cost of sales, and it converts it into a daily figure. Effectively, that's saying is how many days does it take from the acquisition of the raw materials or finished product to convert into a finished product and to get it out the door. The receivable collection days, if we're offering credit facilities, every time you offer even $1 worth of credit, that is a $1 impact negatively on your cash flow. You're funding your customers, and therefore there is a drain on your cash flow. Now, what we're looking for is to convert that customer who owes us money to get that cash in from as quickly as possible. And payable payment days is the other way round. This is where our suppliers are largely funding our business. We procure items on credit. What we're looking for, without alienating our suppliers, is to get the maximum credit period from them. The longer we have to wait before we pay suppliers, the longer we hang on to the cash. A note of caution though. What you've got to be careful of is not to disrupt your supply chain too much, not to alienate your suppliers, not to take the piss effectively, because what will happen is that your suppliers will potentially withdraw those credit facilities. Apologies for any profanity expressed. So let's go through, let's see what those metrics are. Now I'm going to do the calculation first of all. So what we've got here, it's saying fixed asset turnover has increased. Now, as we can see on the balance sheet, the carrying value, the investment in fixed assets has gone up. That would suggest that we've actually acquired more fixed assets during the course of the year. The level of turnover, as we can see, has gone up as well. So we're generating more value in terms of turnover from those underlying assets. That number can also be distorted, by the way, because through the passage of time, as we apply depreciation, the carrying value will diminish. Expenses ratio. Now, perversely, if we look at that, the percentage has gone down, which is good. So we're getting those economies of scale. What it would also suggest is that a large amount of those expenses are fixed in nature. They haven't gone up dramatically with a turnover increase. So that would suggest here, again, we're getting those efficiencies coming in. However, a note of caution. If we look at the inventory days, it's gone up dramatically from 24 to 66. Receivable collection has gone from 30 to 55, and that's not very good news for our credit control, for our cash flow as well. Payable payment days have gone up slightly from 28 to 38. Now, if we look at those numbers before we look at the operating cycle, we can see if turnover goes up, logically, we would expect to have more inventory. That's not necessarily a shock, but it's the proportion, the number of days. What we're trying to do is to keep it constant. Receivable days, again, we've increased the turnover. Logically, we would expect to see more credit customers coming in. But it's the size of the increase that should be a cause of concern. Now, the last metric there, before we add any more commentary, is something called an operating cycle. The old-fashioned term, by the way, used to be a working capital cycle. That tells me I've got to have enough cash available in the first year to fund it for 26 days, and it's gone up much more though in year 2 to 82 days here. So there'll be a massive strain on the cash flow of the organisation. We can see by inspecting the company's balance sheet that it's dropped from 14,000 to 2,780, so there's a depletion of cash. We have a cause of concern because that credit control function seems to be questionable. Now remember folks, we've only got bare numbers to go on. This could be a conscious decision by the business to finance their growth by extending their credit terms. This could be perfectly within their expectations, or it could be, and it's typically the case, that companies that expand, that grow dramatically, they take their eye off the ball and they don't keep an eye on the infrastructure and those credit control facilities, the control of what's going on inside the business is neglected, and therefore danger lies ahead. Now let's have a look at the last quadrants. And this is the risk and return ratios. Now these ratios are more relevant if you've got a public quoted company, because some of these statistics will not be available to private companies. Let's work them out and let's comment on what they mean. Now, dividend yield says if you're an investor, if you look at the dividend that you get back from a company, look at it in relation to your market value, what is the return equal to you? Now the dividend yield has dropped down. Now it could be a cause of concern, but however, remember, investors make returns from dividends and the growth in the shares. Apple is a perfect example of that. In the early days, it never paid any dividends to its shareholders, but shareholders were quite comfortable because the capital value, the increase of the stock value, was enough to compensate for that. Dividend cover says, how much profits am I generating? And that's the profits after tax. In relation to the dividend that the company has decided to give out, can I cover that dividend well? Now, earnings per share is the earnings available to ordinary shareholders. So that's all the profits that have been generated after interest and tax has been settled in relation to the number of shares out there in circulation. And the earnings per share has gone up very dramatically from 32 cents to 81. So as an investor, there's a good tick box there. Now the PE ratio. Now PE ratio is a subject for another video, but what we can observe here, the PE ratio is an indication typically from the stock market about what their idea is for the future prospects of the business. Now that has depleted. It's gone from 6.56 to 3.96, and there could be some issues at concern. If we look at the company's balance sheet, it's certainly got more debt in the balance sheet. There are issues on the liquidity position. There's issues in terms of the working capital, the operating capital, if you want to call it that. What that's saying is the perception of the stock market is that going forward, the company has got some challenges. Now, lastly, the capital gearing. Gearing, or leverage as it's called in some places, is the relationship of debt to equity. Now, as we can see, it's gone up from 2.4 to 8.7. The measure, one measure is to look at the level of debt the company has got. In this case, it's typically the loans. Loans have gone up from 15 to 65. In relation to the equity, the owner's own investments in that business. Now, the gearing has gone up in level, and what that would seem to suggest is the money that's been borrowed has been used to finance the growth of the company in terms of infrastructure costs and other aspects as well. Now, whether that's a cause for concern is a lot of it depends. So these metrics have given us some insight to analysing the company's performance. It enables us to tell a story from some very simple numbers here. However, the questions that it raises means that there's more digging to be done, but we can formulate a very good opinion and a view of the company's performance. Folks, I hope you found this video useful. I hope you found this demonstration really useful as well. Remember, subscribe to keep in touch. I'd love to hear your comments and your feedback, and if you found some value from this video, I'd love it if you could feedback, comment, share it with your friends, share it with your family. Maybe you want to share it with those people you don't necessarily like. But until next week, folks, have a good week.